Again today, S&P NASDAQ on pace for their longest winning streak in about 2 years. My next guest says now's the time to stay invested in equities while also adding exposure to fixed income. Joining me now, Post 9, Sara Naison-Tarajano of Goldman Sachs Private Wealth. Welcome. It's good to see you.
Thanks so much for having me.
All right. So you're positive on the markets because a lot of people are so negative. What are they missing?
Listen, I am positive on the markets. Obviously, we've got a lot going on from a geopolitical perspective, from a rate perspective. But, I run the global family office business at Goldman Sachs. And I think one thing to keep in mind is that we're working with clients who are long-term investors. We're not, working with clients who are answering to a board of directors or thinking about sort of daily market, NAV moves. And therefore, if you can really think long-term about the market, we were advising clients on this, kind of post-summer 10% correction. Anytime you see a correction close to 10% is when you want to be getting longer, especially when you are a long-term holder of equities, which our family office and private clients typically are.
The flip side of that is now that we've had this big rally in the span of a week. So how does that factor into the way I should be thinking? We've spoken, obviously, with your colleague, Tony Pasquarello, on numerous occasions, most recently suggested the path of least resistance was higher. Well, now what? We've had this pretty substantial move.
Yeah, look, I still think you've got the seasonality impact of November and December. We see corporate buybacks, $5 billion a day of corporate buybacks up until December 8th. And then, we've got potentially a perfect storm. I don't want to say it, thinking about, a soft landing. If we think the Fed is done, which I do, that's positive for equities, clearly. If we think inflation can stay under control, which I tend to think it can. If we think the economic data is strong but not so strong, and payroll and wages are sort of at the right place to keep things at a moderate growth level, then I think that positions us really well for equities.
Would you then say you want to move broadly from just mega cap tech? I mean, if you are, inflation is going to be lower than maybe people think, the economy is going to still be more resilient than people think. Does that make the case for some of these other cyclical areas or not? You're kind of shaking your head like you're not willing to kind of go that far yet.
Yeah, I'm probably not willing to go that far yet. And I think it's more for us about just staying long index exposure in U.S. equities and really focusing, if you're going to do single stock work, on companies with strong balance sheet, durable earnings growth, stable margins. You have to keep in mind that even though, we don't think the Fed is going to hike again, we are in a rates higher for longer market, and we have to think about that impact on equities. We still favor U.S. equities, by the way. U.S. preeminence is a big theme for us. Our investment strategy group has had a fantastic call on that. I continue to have that view. But I also think we don't have to be quite as precise if you're talking about clients that hold stocks for years and sometimes decades and generations. So it's okay if you don't get the timing perfect.
But you're not willing to go say that, the Fed, having been our foe, so to speak, by this new, regime they've been on, is not yet your friend. They're not going to cut, because a lot of times you could say, well, we think the Fed's not only done, but they're going to cut, want to get ahead of that. If the Fed, is the game in town that matters most, higher for longer still means it could be a challenge with rates elevated. Yeah,
look, I think, not quite our friend, but not our enemy either, is how I would put it. And I think what I would say about that is, our house view, which I agree with, is we're going to see cuts in Q4 2004. And so actually an interesting topic. We've been having a lot of conversations with clients about fixed income. As you can imagine, we have been super short duration. I mean, it's hard to compete with treasuries 6 months at 5.5%. But if you have the view that the Fed is not going to continue to hike and that actually we're going to cut in Q4 24, then you want to start thinking about extending your duration a little bit. And 3 to 5 years is where we sort of think that sweet spot is with clients. And one nice thing about our client base, particularly family offices, these guys are long private assets, they're long equity portfolios and portfolios that spit out cash dividends. So you don't have to rebalance to allocate new money. And that's, kind of a lot of freedom to take that new capital and think about adding a little duration to the portfolio.
I also hear from many investors who are either, billionaire investors, either family office money or hedge funds, private credit. is hot.
It's a big theme. And, one thing to keep in mind, so we published a global family office survey in 2023. We did the same survey in 21. Our clients are historically under-allocated to private credit. They have a 3% allocation to private credit. This is not surprising. There are a couple factors. We come out of an incredibly low interest rate environment for the last decade.
Yeah, why not be in stocks?
Right, but U.S. taxpayers also have to pay ordinary income in private credit. But today, I actually think private credit is really interesting because you're looking at, double-digit returns, and you've got a client base that is quite overweight equities, private equity alternatives. I think there's a real space in the portfolio for private credit, particularly in direct lending. Those double-digit returns are still interesting after tax. You're higher on the cap stack. You typically have better covenants. There's a lot of things that make private credit interesting.
Talked a lot about that yesterday with Mark Lazary.
Yes, I saw that.
Great to meet. Welcome to our show.
Thank you so much.
Look forward to doing it again.
Such a pleasure.
No, it's our pleasures are. Sara Naison-Tarajano again, Goldman Sachs, joining us right here post 9.